Okay, I think we should get started. Hello, welcome. For those of you who don't know me, I'm Deborah Lucas. I'm the director of the Golub Center of Finance and Policy and a prof at Sloan in finance. And we're here today for our 12th annual conference, which is pretty unbelievable. Every year we choose a different topic. This year I'm particularly excited about the timeliness of this one. Maybe sad that this topic is timely, but nevertheless very timely. So I think we've put together a great program. I'm not going to say much in advance except to welcome you and to ask Eric to come up to start the first session.
Thank you, Debbie. Eric Rosengren. I'll moderate this first section. It's going to be a pretty standard panel in terms of we're going to give 20 minutes for the two paper givers. Each discussant's going to get 14 minutes. Then I'll ask a couple questions, and then we'll turn questions over to the floor. If you look in your program, you'll see everybody's affiliation and what they've done, so I'm not going to do introductions. I'm just going to let people get started, since it's hard to keep people on time as it is. And with that, I'll turn it over to Steve.
Thanks, Eric, and I particularly appreciate your brief introduction because as I've gotten older and people want to list what I've done, just being alive means that list gets longer and longer, and it's actually, I actually have gotten to the point where I don't find it terribly appealing to listen to. So anyway, thank you very much, and thanks Debbie and Peter who organized the conference for inviting me, and thank you for including this paper, which is interesting. This paper is started as a discussion of central bank losses. I was asked by the Netherlands Bank, where there was a lot of conflict between the bank and the fiscal and the finance ministry over what was happening there. And my initial reaction was, oh, this is going to be a very short paper. But then I started thinking about it, and I realized that maybe there was a little bit more to say. So let me see if I can convince you that there's a little bit more to say than the statement that, oh, central banks are part of governments, and if they take losses, it's just like something going on in the government. And you're just not paying proper attention to it, and if you thought about it clearly, you would write one paragraph and then you would go on to the next problem. Okay, so I want to start here. So this is the problem that we face. This is a picture of the size of the balance sheet. These happens to be assets. It obviously doesn't matter. The Federal Reserve in black and the Euro system in red. One is in euros and the other one's in dollars. It's quite amazing how similar they look. There's no reason that they should be lying so close to being on top of each other, but they are. The most interesting thing to keep in mind is that a lot of the purchases that occurred here occurred at relatively low interest rates and relatively high valuations. And so what that means is that as these balance sheets went from roughly $1 trillion US dollars or 1 trillion euros to a peak level of 9 trillion dollars or euros, that you're accumulating bonds that were purchased at high prices, and that there's a risk then that as rates rise, and since rates were extremely low, there was really only one way they were going to go, that you're going to take losses. Now, to give you some sense, just to do something really silly that everyone in here could do, I just want to make do a very quick, very elementary calculation for like an undergraduate. Okay, so this is a calculation that would be in a textbook. It says, let's say that you buy a 10-year to maturity bond. So this is something that remains 10 years to maturity at a 4% coupon with a 2% yield to maturity. You're going to pay 118 for that bond. This example, by the way, is drawn from what the Bank of England actually did, and so the numbers are not imaginary. Interest rates then go from 2% to 5%. The price falls by 92. You immediately have a capital loss if you were going to sell right away. But if you hold it, you have a negative carry because you're actually borrowing at the market interest rate, roughly, in order to finance this position. So for each year that you hold this position, you have a negative carry of 1.9, and then if you hold to maturity, you lose 18. Now, if you do this with $1 trillion face value of bonds at the beginning, which again converted from the sterling levels that the Bank of England roughly did, then what you do is you face $260 billion in losses. That's the net present value. It doesn't really matter what you do in terms of the ordering. You can't change the net present value of those losses. That's what they are. If you decide to hold them to maturity, obviously what you're doing is you're taking losses every year, and then you're taking a loss at the end. But the first lesson of this is that depending on how you do your accounting and depending on what the arrangements are between the central bank and the fiscal authority, this can make a very big difference, whether or not you take the losses now or you take them later, whether or not you account for the losses now or you account for the losses later. So for example, the Riksbank does mark-to-market accounting, fair value on its entire balance sheet. So it did some of this, and it was taking big losses, which it then gets to recover actually later, which is kind of odd, but that's what they get to do. But that matters a lot. So two things make a difference here. One is the order in which you decide to do things, and one of them is the accounting that you decide to use. Just as an aside, there is no best practice in central bank accounting. This is something that I have been claiming for 20 years to central bankers was going to get them into trouble, and voila. In the last few years, it got them into trouble because you can't look and say, oh, we're following best practice, we're doing the way that other people are doing the way we're supposed to do. So every central bank does its accounting slightly differently. There are actually central banks that use IFRS, but it's very unusual to find them. And so that's an important thing to keep in mind. Okay, so the open questions that exist then once you start to think about it is, how large are the losses and how long are they going to continue? Does it matter if the central bank is sustaining these losses at all, or if they're being transferred to somebody else, which actually is in large part happening in some jurisdictions where there's indemnification, so the indemnification matters. Can the central bank become insolvent? I'm not going to have time to talk about this. Insolvency of the central bank is an odd thing to think about because, of course, central banks aren't banks. I actually think we should change the name because people call central banks banks. They think they're like banks. They're not like banks. They're monetary authorities, and they're parts of governments, except for in some strange cases like Switzerland and stuff, where they're privately owned, or the Federal Reserve, which is really weird. But let's not bother with that. I mean, by the way, if they're privately owned or if they're structured like the Federal Reserve, it does make recapitalization extremely complicated. While in countries where the central bank is just owned by the government, you can recapitalize kind of like by waving your hand around. Although that waving probably has to be done by some parliament or Congress or something. But it's just an accounting thing. Who pays the losses and when? And also, we'll talk about quickly some differences across central banks. So I'm going to run out of time, I know, so you're going to give me a test. So let me skip over that and just tell you what the main results are of the analysis that we did with my colleague Jens Hilscher, who's currently at UC Davis. Consolidation is really important to try and interpret what's going on. You need to consolidate the balance sheet of the government. It's one way to think about this is that the central bank is a subsidiary of the government in the same way that, say, the transportation department is. And so you want to actually consolidate those things when you think about what the balance sheets look like. The impact of the losses depends on what the central bank buys. That's obviously not a surprise. It certainly depends on the maturity structure, but it also depends on whether they're buying domestic securities or whether or not they're buying foreign ones. I won't have time to talk about this, but if you're doing what the Swiss National Bank does and buying massive amounts of foreign securities, gains and losses are transfers between domestic residents and foreigners. That's a really different thing from us transferring funds internally inside of a society, one to another. The other, that looks like it's much smaller in terms of its impact. It's important to keep in mind why you do this at the beginning. You're doing this to try and avoid recessions. So if you're going to really do a cost-benefit analysis, the counterfactual you have to think about is, what if you didn't buy anything at all? And is it the case? And I'm not going to make a judgment about this because different people have very different views on whether or not this actually works. My view is it doesn't really work very well, but that's another story. But you do want to balance this off against what you think the risks or the probability of a recession and the expected losses would be in the case of a recession. The timing of sales matters quite a lot, and that's something that again comes up in the Bank of England case that I'm going to try and get to, and other institutional arrangements which I've mentioned already, like accounting and indemnification arrangements matter. So let's start with two balance sheets that are really simple. On the left, I have the balance sheet of a fiscal authority. Think of that as the non-central bank part of the government, and on the right is the central bank. The important items are highlighted, which is that the fiscal authority has an account at the central bank. Remember, the central bank is the banker for the fiscal authority normally. The central bank owns government bonds that are issued by the fiscal authority, and the central bank has net worth. And those three things importantly disappear when you consolidate the balance sheet. So the first lesson here is, and this is why the paper could have been very short, is that the central bank net worth really doesn't play any role at all. It's just a transfer between two different parts of the government. Now, the way in which that transfer occurs, though, can really matter, and that's what becomes important. So as I said, these three things disappear, and these are transfers then inside. And so what matters then is the impact that this all has on the fiscal authority. So what are the fiscal consequences then of the central bank operating in this way? And let me just give a couple of very quick points about differences. So one case is where you purchase public debt, which is the most common case. And in this case, of course, the quantity of public debt that's outstanding doesn't change because the central bank issues reserves, which are zero maturity securities, to banks. Okay, they're restricted. Only commercial banks can hold them and stuff like that. But assuming that the financial system is operating relatively smoothly, that shouldn't matter much. And so what you're doing really then is you're exchanging long-term debt for short-term debt, and you're shortening the maturity structure of the outstanding government debt. Now, you may be doing this in order to try and depress long-term rates, which then brings up a whole other issue as to what it is that the debt manager then does in reaction to this. But that's not what this paper is about. But what it does definitely by shortening maturity structure is then transfer interest rate risk from private investors to taxpayers. That's for sure happening. And it increases the variability then of government funding needs as you go out, because now what you're doing is you're financing short rather than long, and you don't have this. These fixed interest rate obligations, and I'm thinking of fixed nominal obligations. By and large, by the way, these purchases were in terms of nominal, not indexed debt. Index debt existed in some of them, but let's not. But they were second. They were relatively small. Now, if the costs of taxation are convex, So this is a pretty highly technical point, so don't worry about this too much if you don't understand what I'm going to say here. This thing turns out to create a deadweight loss. Okay, so there is a loss associated with this, but by definition, it's about the second derivative. So by definition, this is about curvature of the costs of taxation, and so it cannot be very large, at least not ex ante. Okay, so that I think is an important point to keep in mind. But that some of what I'm saying here relies on things like the expectations hypothesis of the term structure being sort of close to okay and stuff like that. Okay, if you buy private debt, this substitutes private risky debt for public safe debt. A number of central banks did do this. They didn't do it in as large ways as they did with sovereign debt, but they did do it. This leaves net government debt unchanged. It obviously increases gross government debt, but it transfers risks from private investors to taxpayers again. But now, if you're actually doing this, the hope is, of course, that you reap term and risk premia by doing it. Whether that works or not, we can discuss. But again, the expected costs of this shouldn't be very large if you're doing it. Not ex ante, okay? 5 minutes? Okay. Let me look at a couple of examples, two in particular. First, the Federal Reserve. Everybody cares what the Federal Reserve is doing when you're in the United States. So the story here is, and many of you know this already, the Federal Reserve transfers surpluses, which is its interest rate income, to the U.S. Treasury weekly. Securities are accounted for at amortized cost, so they're not marked to market. There are cash flow losses that exist as a consequence of what they're doing with right now, especially when it is the case that the market interest rates, the interest rates that are paying on reserves exceed the interest rate that they're receiving on their bonds. Those show up as a deferred asset. This is an accounting fiction, not in anybody's textbooks, sort of created for the Federal Reserve, kind of weirdly. Other central banks have then decided that, oh, that's a good idea, we'll do that too. And the surplus transfers are then suspended until the deferred asset is zero. And that's going to be a long time from now, okay? So here's what the losses actually looked like. In all the loss pictures I'm going to show you, I'm trying to scale by GDP because I want you to see how big they are. So the first thing is that the blue bars on the left, you want to think of those as seniorage revenue. That's not insignificant, okay? Those are not small numbers in my view, 0.2, 0.3, 0.4% of GDP per year, okay? That's what you're getting in terms of income. But the losses then, they accumulate to 0.87% of GDP over 2023, 2024, and the current year, 2025. And then they're going to turn around by most estimates. Because, of course, the maturity structure of the debt is changing and the interest rate that you receive is changing. These are rather complex these are rather complex to do these calculations, so I rely here on Andy Levin and the Federal Reserve Board and Christina Skinner. The deferred asset will not be extinguished, by the way, according to these forecasts, by the time this graph ends, okay? So that's in 2030. It's not going to be gone. It'll take a few more years after that. The more interesting case, which I'm going to go through, and I promise to be quick, is the Bank of England. So the Bank of England has an agreement with the UK Treasury that it purchased bonds in a subsidiary called the Asset Purchase Facility. It purchased mainly gilts. It purchased a few other things, but those are unimportant in terms of their size. And in these calculations, they're gone. The bank lends to the Asset Purchase Facility to finance these purchases, and it lends them at the policy rate. So now you have this problem that there are cash flows from this that can be positive and negative. The cash flows exist when the interest rate on the bonds exceeds that of the policy rate, there's a positive carry, and when it's below, there's a negative carry. And the indemnification rule is that the Treasury either receives the benefits of the positive carry, or makes a transfer quarterly to the asset purchase facility for the to fill the hole made by the negative carry. It's reimbursing them. The expected costs ex ante, again, seem to be modest, but the ex post costs can be large. This is a end of 2023 calculation. The nominal value of the bonds that were being held was 630 billion pounds, but the purchase price was 744 billion pounds. So you can already see a problem, because here you've got 100 billion pounds in upcoming, at some point, you're going to have that in terms of the loss that you're going to face at maturity. The cash flow losses in 2024 were roughly 21.9 billion pounds. Now, if I look at the losses, assuming that they just allow runoff, these are the losses that go out for as long as the maturity. They tell you the individual bonds that they hold. So it's very easy to do these calculations. And you also know what the forward curve is for the bank rate, because the Bank of England publishes one. And so you can calculate this. And you can see here that these numbers for 2023, the number's huge. It's 1.5% of GDP. They're still relatively big, but then they start to die off. But they go out till 2070. Roughly, because the Bank of England in the asset purchase facility chose to buy 75-year bonds. We can ask about the wisdom of that. The sum of this is 7.8% of GDP. I'm out of time. Okay, I'm just going to show you one more thing. Yep. Okay, so the Bank of England has chosen to sell rather than to allow this to run off. And this picture here shows you in red what happens if they sell at the rate which they've been going. And so one question that you have to ask yourself is whether this makes any sense, because they're destabilizing the fiscal budget by doing this. And I think that's an interesting question to ask yourself, because what's happening is that when they chose to sell, they've brought forward the present value of all of those losses, and by bringing those losses forward, they've created a burden for the Treasury, which already has a burden on it. Now, if you're going to, anyway, let me just quit there and with this and ask whether or not what we need, and this is a discussion for later, is a new monetary and fiscal policy framework, because what we have now is big central bank balance sheets that are affecting fiscal policy, and we have fiscal policy makers then that care much more about what the central banks are doing. Thank you very much. Sorry I went over.
Thank you, Steve, and Kristin will discuss the paper.
Okay, thank you very much. Could you throw up that? Awesome, thank you. So it's a pleasure to be here to discuss this important paper. As Debbie said, this conference is very timely, but this paper, of all the papers that are all timely, is particularly timely. This is the big feature article in the FT yesterday or today, if you read the old-fashioned hard copy version of the paper. There is extensive debate today about large central bank balance sheets, and part of that is about the fiscal costs. So if you want more on the topics we're discussing in this section, I highly recommend you read this article out in the FT today or yesterday. But despite all this discussion, despite all the attention that has been given to this, it is a poorly understood topic. Once you get below the headlines, really digging into this and understanding the issues is not straightforward, even for people who think a bit about balance sheets and central bank policy. Just to show how poorly understood this topic is, I'm going to show you some of the headlines that have also come out in the FT over the past few months in Alphabet, which is one of the columns where they're actually really trying to educate people about these issues. He or she, whoever the writer is, talks a lot about central banks and balance sheets and QT. And clearly, they write these pretty good articles getting into some of the guts of these issues. And then the people who put pictures with the articles try to find a picture that matches what they're writing about. And here's the pictures they've been choosing recently. So some discussion about balance sheet policies compared to like a global apocalypse. This is really bad stuff.
Then they seem to think, no, we need to take a lighter note. Maybe it's not so bad. So then you had a bunch of articles about balance sheets and QT that have cartoons. And then the most recent one, I still can't get my head around, big article that was pretty good on QT. This was the cover picture, which for the life of me, I can't figure out how this relates, except they're really trying to get you to read these articles. But it does highlight, once you do get into the weeds, it is pretty techie stuff. It is pretty hard to get public attention to really think about these issues. It's not easy stuff. But this paper does a really good job of making it understandable and readable and sort of cutting through a lot of the jargon to just understand what the issues are. So why is there so much attention to these issues today? Especially given that it's so hard to draw people in and you have to resort to pictures like this. Three main reasons, at least, why this is really bubbling up and become such an important topic. One is there have been a number of evaluations going on around the world of central bank responses to the pandemic and especially to the recent inflation surge. Why did they miss the surge in inflation? Why were they late responding? What's the responsibility? A key focus coming out of many of these evaluations is the role of balance sheet policy. As central banks have shifted from just adjusting interest rates to using their balance sheets more actively, there's a lot of concern that that may have contributed to the inflation surge. Was it the right set of policies? Was it done well? So that's just a big focus that everyone, and there have been a lot of sort of lessons learned, things that might have been done better or done differently if balance sheet policy wasn't done during the heat of a crisis and there was more time to think about these issues. Another reason these issues are getting a lot more attention is the related but even broader issue of concerns about the expansion of reach of central banks, of the independence of central banks. How much authority should unelected officials have when they're buying and selling corporate bonds, for example, and making market decisions? So that is part of a much bigger debate, which is playing out in the US as well as around the world. And then the final reason this is getting so much attention today is the fiscal implications of large balance sheets. Two things are hitting at once. First, countries are under much more extreme fiscal pressures. We're seeing yields go up, debt is going up. People are paying more attention to that. A number of countries are trying to deal with budget deficits, and it's at the exact same time, for some of the same reasons, that these large balance sheets are shifting from earning governments money to costing governments money. And that's particularly clear in the example Steve just showed for the Bank of England, where no one really was worried about the large balance sheet when the Bank of England was sending a profit of up to 2% of GDP or 0.5% of GDP each year to the Treasury. Now they're costing the Treasury every year. No wonder it's getting a lot more attention. So many reasons this topic is one we all should be talking about and thinking about more carefully and trying to understand. So that's where this paper comes in. It makes a number of contributions to push us forward to understand these issues. First, it just provides a pretty straightforward, clear framework for thinking about the fiscal implications of central bank balance sheets. So very handy. This is great to use in the classroom, pretty straightforward to understand, especially because central bank accounting is a little different than traditional accounting you learn in MBA programs, for example. Another contribution to the paper, it provides some clear losses or estimates of the magnitudes of the losses from large central bank balance sheets. That may sound trivial. It is not. Someone who has worked on this data, pulling this together across countries is not straightforward. You can do sort of a quick download of some of this from Haver, but once you dig into the details or try to match it with what central banks publish on their websites, putting all this stuff together, again, is not straightforward. There's a lot of accounting issues, what you count, what you don't count. So it is really nice, thank you, Steve, for someone to pull all this together so you have it all together in one paper to look at and think about and to compare with some of the numbers being thrown out in some of the public debate. But what I think the nicest contribution to this paper is it highlights the importance of institutional structure and accounting policies for how central bank balance sheets in turn imply fiscal gains or losses. It's easy if you just looked at one country, say the Fed, and you just assume, oh, that's how it's done everywhere, that some of these accounting practices or sort of standard practices are done. But what you realize by a cross-country comparison, which they do in this paper, is that there's some very, very different ways to run your balance sheet and account for losses. And that can have first-order implications for how the public debate goes and what the implications are for governments and budgets and a whole set of issues. For example, 3 that Steve and his co-author highlight in the paper, which I didn't really have too much time to get into, but are very important, is countries have to decide on the timing of when they realize losses and gains. Some countries, like Sweden, do mark-to-market. So when they hold these assets and they go up or down in value, it's priced in slowly as these adjustments happen. Others only price in any losses when they sell a security, it rolls off. So you may suddenly have a big fiscal hit. That can have first-order implications on how you think about these adjustments. Another important institutional difference is the timing and form of how you transfer any gains or losses to the fiscal authorities. In some countries like the UK, any loss on your balance sheet has to be transferred to the budget that year. So you can see why it gets a lot more attention. In countries like the US, you can have some big losses, but that can just be sort of buried in the Fed's balance sheet as a deferred asset or deferred liability, and then they sort of work it off gradually over time, and it never is passed directly, clearly into a government's budget that year. So you see why there's a lot more fuss about this in the UK when the government has to deal with the fiscal implications each year versus in the US where it can be sort of hidden away in the Fed's balance sheet and not passed on directly or as transparently. And then Steve didn't have much time to talk about it, but if you also bring in Switzerland into the discussion, which is a big part of the paper, you also see some important implications of whether you buy domestic or foreign assets. If you buy foreign assets, then these losses are transferred abroad to foreigners, and there's another whole set of implications. And those costs can be quite large, as it shows in the paper for Switzerland. So really important differences in how countries are doing this with really different implications for how any fiscal gains or losses are transferred to the government. In this big picture, I think this paper really shows the benefits of doing this type of cross-country analysis. It's not easy, but it really does drill into what some of these differences are, what some policy options are, too, that you might not otherwise be aware, that there are some really different ways to do this. And this just sort of highlights how these cross-country differences in accounting practices, institutional practices, can have a big impact on the costs of these balance sheet policies. So this is some results from a paper I did on quantitative tightening when you shrink your balance sheet with Wen-Chin Du and Matt Luzetti. And what we do is we look at the effect when a country announces QT. So it announces it's going to shrink its balance sheet. And the colored bars show the impact on government bond yields of different maturities. So say focus on the purple, that's the effect on 30-year bond yields. You see really, the key point is you see very different effects when a government announces it's going to start QT on bond yields across countries. Why is that? There are obviously a lot of cross-country differences, but one factor that contributes to this is the accounting practices, the institutional practices, and how they're adjusting their balance sheet. So for example, New Zealand, Sweden had some big surprise announcements of doing QT sooner than expected. People weren't expecting it. They did active sales, which is more aggressive, but they have much smaller effects. UK did a similar active sales, and it has much larger effects. And again, I think some of these accounting practices of how you account for the losses is one contributing factor to the differences, albeit not the whole story. What? 4, okay. So I'm not just supposed to compliment the paper, I'm supposed to make suggestions. So I don't have a lot of suggestions. I think really well done paper should be required reading for anyone working at a central bank or thinking about these issues. Mainly thank you, it's a public service that he pulled all this together for us. I really just have one big question and one clarification. My big question is the way the accounting, the framework for the paper is you can merge the central bank balance sheet with the government balance sheet to account for the fiscal losses. I think that's useful to think this through as an exercise, but important to realize in practice, if you actually merge the two, you would have another whole set of implications and secondary effects that you would have to take into account. I don't think Steve is suggesting central bank balance sheet should be merged with the government. Then you'd have issues around central bank independence, credibility. If, say, raising interest rates increases the losses to the central bank, and that directly goes to the government, that could hinder the central bank's ability to raise rates, for example. Or the other way around is occurring in the UK. If we see a country where it is more closely merged, then when the central bank has losses, the government has to adjust its fiscal policy and has to adjust taxes or spending because of the losses in the central bank. So actually merging the two would have some other implications. The other just clarification is, in the paper it generally talks about the central bank balance sheet assuming it's government bonds. But what if central banks hold larger balance sheets for reasons other than monetary policy, buy things other than government bonds? For example, the UK during the LDI crisis, they bought a bunch of bonds really quickly and then sold them really quickly, made some gains. Should that be treated differently? Should that be part of the same discussion, or do you need a whole different set of practices? My main suggestions, though, are not for this paper. It's already something like 80 pages. It doesn't need to add much more. But it does raise a number of important issues that I would love to see in a next paper, hopefully. I'm just going to mention those quickly. One is what is missing that I think is very important is for central banks to think more about what they buy and hold on their balance sheet. Lumping everything together as government bonds does miss a lot of important factors. And this is something central banks were not thinking about enough when they were buying in panicked moments of crises. Critically important is think about the duration of what you buy and hold. You can't just, all government bonds are not the same. Some will roll off sooner. Some will be around for longer. A good example of this and why this matters is this is the reduction in central bank balance sheets that occurred through the end of 2023. All of these central banks were shrinking their balance sheets. You see faster roll-off in some countries that were doing active sales as well as letting bonds roll off when they expired, like New Zealand, Sweden, and the UK. Canada, though, didn't do any active sales. They just let bonds expire, and yet they've been some of the fastest to shrink their balance sheet. That's because they mainly bought short-duration bonds that would then roll off really nicely without a lot of the issues that others are having when they actively sell them, and that Steve mentioned. So if central banks think more about what you buy more on the short end, short-duration bonds, you could shrink your balance sheets more quickly without some of the costs that come from active sales. But then you'll also have some different effects on different segments of the yield curve. So there's a lot to think about there that's worth including in a discussion. Similarly, in the US, they bought mortgage-backed securities as well as treasuries. Those are not rolling off as quickly because when rates go up, no one wants to refinance their homes. So it's another sort of set of issues to think about when you're thinking about the cost of large balance sheets, how they shrink. What you buy does matter. And that has really not been part of this discussion or debate. Second suggestion? Time's up. Okay, I'll just say this one. Also some thought about when you do adjust your balance sheet, active sales versus letting bonds roll off, which Steve touched on at the end. If you do active sales, you get bigger effects on yields. That's shown in blue here. If you just let bonds roll off, there's a smaller effect on yields, and that should also be part of the consideration when you adjust balance sheets. So I had lots of other suggestions. I will leave. And just end on this note, the one other topic that would be great, and also links to the next paper, is thinking about how these balance sheet positions also relate not just to the fiscal position of the government, but the fiscal position of each country related to the rest of the world. There's been some really interesting trends, which I guess I will not have time to go over, on how net international investment positions, what the country owes the rest of the world, have changed quite dramatically since 2008, since the era of large balance sheets. Switzerland's been making some losses, pretty substantial losses. To the rest of the world, a big part of that story is what's going on with its balance sheet. The US has lost its exorbitant privilege. That's not all due to the balance sheet, but it might be part of the mix. So the bottom line, important paper, we need to understand these issues. This is very timely for the debates on the future central bank toolkit and independence, and central banks do need to think more carefully about these institutional arrangements, which Steve highlights in the paper. Thank you.
Thank you very much, Kristin. Mindy, could you come up and present the paper?
Okay, so this is the button.
Okay, great. Thank you. Thank you for having me here, and it's great to be in this exciting program. So this is a paper, actually together with a common set of co-authors. We've been thinking about this question of fiscal sustainability in a set of papers. So this particular one is on exorbitant privilege, and we try to look at this question from the historic angle. Okay, so exorbitant privilege. I guess I don't need to define this in this crowd of audience, but so we know that in the international monetary system, it has been characterized as a configuration where there's this hegemon, a leading dominant country who issues the most amount of the safe assets in the world. And we know that US has been this hegemon for decades. So being this hegemon, let me quote this paper, being this hegemon confers a specific ability to issue a large amount of nominally safe asset, mostly government debt. Not just that, they can issue those debt at a higher price. And in addition, if countries like US, in the case of deficit, they don't need to take very restrictive measure of their balance sheets. So that's the benefit. Being the hegemon country, that's the exorbitant privilege. So with the rising concerns of fiscal sustainability of US and countries around the globe, so the questions we really want to ask is, how can we weigh this exorbitant privilege against this rising concern? Or how long, can we enjoy this exorbitant privilege? So hopefully this paper can shed some light on that, not completely answer the question, but shed some light on that. So what we're going to do is we're going to look back for 3 centuries of physical history. We try to study the Dutch Republic, UK, and compare it to the US government debt. And then we're going to take a very standard, very classic asset pricing approach to come up with a physical valuation. So what we found is not just the countries being in the, as a unique hegemon, they can issue government debt at a much lower yield compared to other sovereign debt, but also what we found is those countries can enjoy extra physical capacity, or what we call physical backing in this paper, compared to what can be warranted or justified by their fiscal fundamental, okay? And even after we factor in the seigniorage revenue from the convenience yields of those debt. Well, the bad news is this is not gonna last forever. So what we found is when these hegemons' relative fiscal fundamental deteriorated, the bond investors actually gonna withdraw those extra fiscal capacity, and countries like UK, they lost the exorbitant privilege after the World War II. Okay, so let me give you a preview of what we're going to show you today. I'm mainly going to focus on the UK compared to the US, and if time allows, I'm going to briefly talk about the Dutch Republic. So we know that 2 centuries before the Second World War, UK is the sort of the quasi-monopoly of the safe asset suppliers. So London was the world's financial center, and actually in 1815, gilts, the UK government debt, is accounted for more than half of the traded securities in the world. So they were definitely dominant. And gilts traded at much lower yields based on the existing study by Hall and co-authors. And based on our estimates, before the Second World War and before the First World War, only about 3/4 of the UK outstanding government debt can be justified by the present value of the current and future, primary surpluses. And then we go into this interwar period, interbalance. So it's interesting, actually, they struggle quite a bit. So UK was actually in fiscal crisis. There's debt restructuring in the 1932, and they abandoned the gold standard, came back briefly and permanently abandoned it. And then also you see financial repressions, and then you start to see gilts traded at much higher yields than other foreign sovereign debt, okay? So then after World War II, we all know that the UK kind of handed over the hegemon to US, and then you see the reversal of the fortune. So for the US, based on our estimates, after the Second World War, the market value of the US debt is way above the what we call physical backing, meaning the fiscal fundamentals present value. But this is not the case before the Second World War. So US government debt was more than fully backed by its future and current primary surpluses. Okay, so without further ado, let me briefly introduce the methodology, and then I'm going to show you the results. So we start with this most standard and common equation in the public finance, so government budget constraint. Okay, so the first equation was just a accounting identity, basically. And then we impose a no arbitrage condition on each bond, and then iterate this equation forward, so we get to these intertemporal budget constraint. Basically says that the DT, that's the market value of the government debt, equals the present value of all the future surpluses, the T minus G, and discount it back to today, and then plus the terminal term. So we define these red term, basically discounting current and future primary surpluses, calculating the present discounted value of that term, and we define that as the physical backing. That's what we call the physical fundamentals. So that's the object we want to estimate, and we compare that to, ideally compared to the market value of the debt. So if the transversality condition holds, we have some discussion in our other work, and then basically the market value of the debt, if the intertemporal budget constraint holds, it should equal to the present value of the primary surpluses. So the exercise is to come up with the estimates of the physical backing. So basically, we're going to try to estimate the present value of the tax revenue minus the present value of the spending. So think about two assets. One generates a cash flow, that's tax revenue. Another asset generates a cash flow, that's spending. But these two assets are not traded, so we cannot really observe the value. So we need to impose some assumptions. So how do we think about that? This is where we introduce the asset pricing tools. So we think about the value of the tax claim is the tax revenue multiplied by these, what we call the price dividend ratio, valuation ratio in stocks, right? So P over T. And then minus the G, that's a spending multiplied by a valuation ratio of the spending claim. So how to get at this PD ratio, valuation ratio for these two claims? We use Campbell-Schiller decomposition, which is just linearizing the return equation of these tax claim and spending claim. So no optimization here, just literally taking the definition of the return equation, take log linearization, and iterate forward. Okay, so this will give us this price dividend ratio or valuation ratio of the tax claim and spending claim, and both a function of expected future cash flow growth and the discount term, expected future discount rates. So it's still very complicated. We need to kind of project what's the cash flow growth, what's the tax revenue growth, what's the spending growth, and also the discount rates on these two cash flows. So we need to take some stand on estimating these two objects. Two exercise, we'll do two exercises. The first, we're going to look at the steady state, what we call the steady state physical backing, where we need to take a stand on the long-term growth rate of the tax revenue growth and spending growth, and also the discount rates on these two cash flows. And then we're going to introduce some dynamic and hopefully give you the picture of these dynamic physical backing. Okay, so actually the steady state physical backing can give us a lot of intuition. So okay, here it is. So we take this equation, thinking about a steady state, the tax revenue to GDP ratio should be constant, and spending to GDP ratio should be constant. Basically, the primary surplus to GDP ratio should be constant at steady state. So what about the valuation ratio for both tax revenue claim and spending claim? Well, these two, the joint equation, if you think about sort of a Gordon growth formula, the price to cash flow ratio for tax revenue and spending will be kind of a version of 1 over R minus G, right? So there is a discount rate component that's in the red, and the growth rate component, it's the blue, okay? So what happened at steady state? The tax revenue and spending will grow at the same rate as the GDP, and they're co-integrated. So they both have the same growth rate as the nominal GDP growth rate, so that's the blue term. And then what about discount rate? It will be constant. It consists of a short rate and the yield spread and the risk premium, okay, of both either tax revenue and spending. So what's really different is the risk premium of these two cash flow streams, the tax revenue and spending. So think about it. If we have a very safe tax claim or tax stream, so the risk premium of the tax claim will be low, which means the price to dividend ratio of the tax claim or valuation ratio of the tax claim will be high. That means at steady state, a country can run deficit, but enjoy still positive fiscal capacity. Okay, so the size of the risk premium actually very important to think about these fiscal backing concept. But the question is, how big are they? What are they? Well, let me take you through this thought process we think about in the long term versus in the short term at the business cycle frequency. So again, in the long run, we expect at steady state, the tax revenue and spending should be co-integrated with GDP. So in a representative agent model with long-lived agent, you will expect the risk premium or the riskiness of the tax revenue and spending should be the same as the GDP claim in the long run. But at the business cycle frequency, in the short run, given the current tax scheme, we know that the tax revenue is pro-cyclical, right? It's riskier than the GDP claim, and the beta is higher. And the spending is counter-cyclical, right? So it's kind of a hedge, it's safer. So at the business cycle frequency, in the short run, we expect the tax revenue actually is riskier, should have a higher risk premium than GDP, and then it has a higher risk premium than spending claim. So if that's the order, what do? We're going to further assume these three objects are the same, meaning we're going to assume the tax revenue and spending will share the same risk premium as GDP. What this will give us is the upper bound estimates of fiscal backing. Basically, we reduce the valuation ratio of the tax claim, and we increase the valuation ratio of a spending claim. We're making spending more expensive and making tax cheaper, okay? So this will give us a sort of upper bound estimates of fiscal backing. This is the assumption we're gonna carry through the whole analysis. So what does it tell us? It tells us something very simple. Okay, so the fiscal backing, the upper bound of the fiscal backing of a country at a steady state will be the primary surpluses multiplied by a multiplier, which is the GDP's price dividend ratio, or valuation ratio. So what's the insight? You can see that in this equation, if a country has a high GDP growth or a low interest rate, you will have a high valuation ratio, and it's going to boost your debt capacity or fiscal capacity. But instead, if it's a country has a high risk premium, okay, high GDP risk premium, or a steeper slope of the yield curve, meaning high yield spread, it's going to lower the valuation ratio of GDP and reduce the physical backing or the physical capacity. And of course, we need to come up with a number. This might not be the perfect. We're going to assume the GDP claim is essentially the total wealth portfolio, so the risk premium on the GDP claim will be proxy as the risk premium of the total wealth portfolio, which is, again, proxy by the unlevered stock return, and using different ways to calculate these number over different samples for different countries. So we believe a fairly conservative number, 3%. Per year, and we use the fixed same number throughout the whole sample, and also for both the US and UK for the easy comparison. And we did some robustness around this number. Our results remain the same. Okay, so that's the first risk premium of GDP. The second is about convenience yield. We have to talk about convenience yield because of, for different sample period, some countries enjoy convenience yields, some don't. So from the existing literature, we're going to use attributes, convenience yields from the violation of CEPR and under the gold standard in absence of default. So interest rate differential will just be the violation of CEPR. So you're looking at the figure here is the interest rate difference between 15 other countries under gold standard and the UK. Okay, so the positive number means the UK yields are actually lower than the other countries at the same time under the gold standard. And the black line is the short rates, and the dashed red line is the long rate. So you'll see on average, especially before the 1930 or 1931, these rates are way above zero, and then after 1950, right, the yields of the UK that it's actually higher than in the other foreign countries. So based on our estimates, the average convenience was about 199 basis points per year before 1931. And how to introduce the convenience yields to the model? Well, because countries like UK before the World War I can issue debt at a higher price, so this brings in additional seigniorage revenue based from the convenience yield. So we introduce this additional cash flow term in the intertemporal budget constraint, and we can revise the upper bound by simply adding this additional seigniorage revenue. And it's a sizable but not huge term based on our estimates. Again, this number for the UK is about 0.33% of GDP before the Second World War. Okay, so.
By
5 minutes? Okay. So what do we get here? So that's the steady state estimates. Before the World War I estimates, you see the valuation ratio, which is an important number for us. For UK, it's about 20. For US, it's about 34. It's much larger for US because of the high growth rate in the US before the World War I. And what does this number 20 mean? If a country like UK wants to boost their fiscal capacity, increase 1% of surplus to GDP ratio will increase about 20% of fiscal capacity. And then you look at the number, the fiscal backing is about only 55% of GDP and way less than the outstanding debt, about 86% of GDP. And that's not the case for the US. For US, it's about 130% of the debt can be justified by the fiscal fundamental. Okay, so that's the steady state estimates, and let me briefly talk about how we do the dynamic setting where we're gonna allow the expected tax revenue and spending growth rate to be projected to come out from this VAR, and also we allow the time-varying expected return, still fixing the GDP risk premium to be 3%, but allow the interest rate and yield spread to be changed following this VAR. And we also, one important thing to note is we're going to estimate the VAR in 2 separate samples before and after the Second World War. Okay, so assuming there is a region switching. And then if we do that, so this is sort of the most important figure of the paper. So this is the UK and US fiscal backing before the Second World War. The red line is our estimates of fiscal backing, okay, which is an upper bound. I want to remind you again, that's an upper bound. And for UK, we actually includes the convenience yields already in this case. And the blue line is the outstanding market value of the debt, all as a fraction of GDP. So you see, throughout almost this entire sample, exactly, especially before the 1870, the UK government debt, outstanding debt, is way above the estimated fiscal backing, and this is not the case for the US back then, except for briefly in the inception of the nation during the Civil War. Most of the sample, the outstanding debt is actually below the red line, the estimated fiscal backing. So here's the number. I think I will, given the time, I will skip the number. Just one thing to know that the correlation between our estimated fiscal backing and outstanding debt is actually pretty high. So this is not mechanical. We're taking all the numbers from the balance sheets, and the debt value is just the market value of the debt. Okay. So what about post World War II? You see the reverse of the fortune, right? On the left, the figure A, that was the UK. Almost entire sample, okay? The red line, our estimated fiscal backing, is way above the outstanding debt. But for the US, it's a different story. So except for briefly the short period in the 2000, the Clinton period, and most of the time, the present value of the surpluses, including of the synergy revenue, is way below the outstanding debt. And what exactly is the number here? So the fiscal backing estimated in the US is 12% of GDP compared to the outstanding debt on average is 40%. So we're talking about less than a third of outstanding debt can be justified by the fiscal fundamental. And for UK, this number is about 159%. And I also want to make you aware of this very low correlation about these two lines. Especially in the last two decades. Sorry, I don't know how to come back, yeah. And this actually, the gap is widening quite a bit. Okay, so I think I probably just have 1 minute to touch on Dutch. So not surprisingly, this what we found before the UK, the 17th century and part of the 18th century, Dutch Republic, at least the Holland province of Dutch Republic, was the local monopoly of the safe assets. So we have evidence their yields of annuity actually are traded at a much lower, 1.5% lower than the British consols, and then after 1815, and then the position switch. So our estimate shows results before 1815, the Dutch Republic was able to issue a lot more debt than justified by their fiscal fundamental. Only about 63% of the outstanding debt was justified by the fiscal fundamental, and this number goes beyond 100% after 1815. Okay, so yeah, this is the figure. Okay, thank you. So yeah, this is what I got today. So we take a historical approach, estimate the physical fundamental, the value of physical fundamental of 3 major nations over 3 centuries, our conclusion is investors do concentrate astrophysical capacity on the world's largest safe asset supplier, but the bad news, or maybe things for us to think about, is this is not going to be forever. Okay, thank you.
Adrien will be discussing this paper.
Well, thank you very much, David, for the invitation to discuss this paper. I really enjoyed reading it. I think it's an invitation to rethink what exorbitant privilege is. So let me start from the way we would talk about it in international economics. Here in red, you see the US net international investment position. As you all know, we have a lot of debt and much less foreign assets, so it's very negative. We're talking about trillions of dollars. But on the right-hand side, you see the thing that is a little bit negative. We have a lot of debt, but we still receive a lot of revenues from the rest of the world. And so how could this be? Is this the sign of the exorbitant privilege? In a narrow definition, it would be. You can think about the case where, indeed, the liabilities L are much bigger than the asset A, but think about different returns on assets and on liabilities. So I'm going to take numbers from 2020, and let's imagine that we have a return on assets of around 3.5%, and we borrow at 2%, just to get an order of magnitude. Use the numbers that are on the balance sheet of the US, and if you just do the math, you would see that our income from the rest of the world would actually be positive. Even if we have so much debt, it would be positive to the tune of 200 billion, which is exactly the order of magnitude that you see in 2020. So once we define the exorbitant privilege this way, then it's an invitation to talk about why do we have such a high return on our assets? Are we running the country like a big hedge fund? And if we're entering the rest of the world, clearly we're going to need to have some transfers in bad times. That's the line of research that has gone after the work of Gorenchas and Ray. There's another way to look at this and to say, look, how come we can borrow at such a low rate? And so maybe it's because the rest of the world is willing to pay a convenience yield to hold this US Treasury bill. But I think what this paper is doing is going way beyond that, because this is a very relatively narrow view, because you only think about the foreign assets and the foreign liabilities. So what they're going to do is that they're going to revisit this whole question of exorbitant privilege, thinking about the whole debt. And they're going to do is going back in history, so the Dutch Republic, 17th and 18th century, and then the UK, 18th and 19th, and then the US, 20th and 21st. And what we're going to bring is a bit of complex methodology, but I can show you the gist of it. It's a VAR with a lot of variables, 10 variables. And it's based on a Campbell-Schiller log linearization. We're going to try to extract what are the expected cash flows and the expected discount rates. And from that, we can compute the present value of debt using the synchronization. The key assumption is going to be that the discount rate is equal to the long-term bond yield plus a constant GDP risk premium. So I'll come back to that. The bottom line, and the thing that I'm going to repeat 3 times to make sure that you all remember, is the following. When a country is a dominant safe asset supplier, it can issue more debt than what is justified by its future primary surpluses, even after accounting for senior age revenue from convenience yields on the debt. So, okay, this is the key graph, as Mindy said. It's beautiful. At every point in time, you can compute what is the amount, the fiscal backing, what is the amount, the expected net surpluses that you have in order to justify your debt. And what you see is that in the UK, before World War II, in some sense, the debt level was much higher than what the net surpluses you could expect at the time. This is before World War II on the left-hand side. On the right-hand side, you have the same graph after World War II, and you see the situation reversed. And if you go to the US, just look at the US after World War II, we're in a situation where if you look at the surpluses that we have right now, and from the surpluses that you observe, you infer the surpluses that you could expect, then it looks like our debt is much too high. Okay, so that's the paper in 2 graphs. So as you could see from this presentation, there's a big machinery that is behind. So what I'm going to try to do is see if it passes the smell test and try to give intuition for the paper in a very, very simple way. And the answer is going to be yes, right? I'm completely behind the result. I want to show you also that the results are intuitive, but we do not depend on the discount rate, which seems like a very important choice, but actually the results are robust. And that actually the convenience yield that Mindy mentioned at the end you'll see that we can actually ignore, and we would get the same result. And on top of it, I think, if anything, they could be a little bit lower than what the paper uses. So let's start from the same equation that Mindy used. The debt is the present value of the net surpluses. There is some stochastic discount factor M, but I'm not going to get into a model of the stochastic discount factor. Let's do something super simple instead. Let's go back to the Gordon growth model. Let's assume that the net surplus is going to grow at a constant rate G. And you have a discount rate R. And G is constant, and R is constant. This is MBA math, right? And so what is the debt as a function of GDP? Well, it's just what you see the surplus now multiplied by 1 minus R minus G. So I'm going to pick numbers so that we can all do the math in our head. I see in the paper that the surplus on average in the UK pre-World War I was 9% for the taxes, 6.5% for the government revenue, so the difference is 2.5%. I'm going to take R minus G equals to 5%. Why? Why not at this point? Okay, it's just because I can do 1 over 5. And if I do 1 over 5%, I get 20. And so if I multiply 20 times 2.5, I get 50%. Done, right? And this is the fiscal backing. And immediately you see that, yes, actually, it was much lower than the actual debt of the UK in that period. And Mindy reported a number of 86%. So, yeah. I'm going to say it again. When a country is dominant safe asset supplier, it can issue more debt than what was justified by its future primary surpluses. I think they made the point very clearly that works. And if you actually look at the same data after World War II, well, you can just redo the same math. Again, the present value of a stream of payment that increased at a constant rate, it's 1 over divided by R minus G, starting with the first dividend, so or the first payment. So what is the net surplus on average? After World War II, the level of the government in the UK is much higher, but the difference between taxes and revenues is pretty much the same. It's like 2%. R minus G, this time I'm going to take 2.5. You see that I'm changing my number? It's not random. And the fiscal backing, so I picked 2.5 because I can, again, do 1 over 2.5% in my head, and that's going to be 40. So fiscal backing is going to be the surplus, 2% times 40, that's 80%. And again, Mindy is right. That number is much higher than the actual debt in the UK post-World War II. So I think you can believe the results. They completely passed the smell test, but of course, they bring some new question, which is like, okay, how big should be the discount rate? How did I come up with my 5% and 2.5%? Where is the magic? And is there something else coming from the senior age? So I'm going to go for that. So the discount rate, I'm going to follow the paper and say, okay, let's imagine that the right discount rate is the 10-year bond yield plus a constant 3% of GDP. Let's do that, and then let's discuss. So if we do that, we start from the level and slope of the term structure in the UK before World War I. And so the level was 3.67%. The term structure was actually on average negative, so you get a long-term yield of 3.46%. I'm going to take inflation of 0.16. It's straight from their paper. And if I compute this R minus G that I need in my Gordon growth model, what do I get? 3.46 plus 3% minus 0.16, that's 6.3%. So indeed, that's above the 5% I showed you 2 slides ago, and so the whole reasoning is going to work. Now, you may think, oh, where does this 3% come from? I actually am not completely sure about the risk premium on GDP. Well, you should not worry too much, because imagine there's no risk premium on GDP. Imagine that you really think of wealth as just the present value of future consumption, and you're willing to say that it's as risky as a long-term bond, not more. Then forget about the 3% on GDP, and your 1 over 1 minus G term now becomes 30. And the same point applies, because if I multiply 30 by 2.5%, it's 75%. So again, it's still well below the debt that the UK has. So I think the point that Mindy is making is completely robust to the choice of the GDP risk premium. Now, if you do the same thing after World War II, you have to be a little bit more careful. Again, we can justify the discount rate. Let's look at the 10-year yield. At that point, the level of the term structure in the UK is much higher. The slope is slightly positive. So the long-term yield in the UK is 6.44%. subtract the inflation, and you have your R minus G again. That's going to be 1.66%. So indeed, it's lower than the 2.5% I used in my very simple example. So the point is going to be valid, looking at the data. But here you have to be a little bit careful, because if I want to try to do the same experiment and say, okay, what happens if the risk premium is 0? When if the risk premium is 0, the whole present value goes to infinity, so it's no longer work. So clearly you need to think about the risk premium if you want to have some infinite value, but the result is very, very robust. So what does it mean? It means that when we think about the expected net government surpluses that we can infer from what we see, and we discount them properly, then there are points where countries are in trouble, and that's exactly the case of the US right now. Now, the beauty of our paper is that they look back. So what do we learn from looking back? Well, we learned that there are two potential outcomes. One is default, and that's the Dutch Republic. So they defaulted 2/3 on their debt in 1810, and that's Napoleon's fault. Okay? And the second outcome is a regime change. And you have a regime change not just in the government surpluses, but in the discounted net government surpluses. Because if you remember my simple example, the government surpluses in the UK didn't change that much in the pre-World War I versus post-World War II world. What really changed is the way we discounted them, the way you compute the present value. And so here you see a little bit of a tension that would be present in any exercise of this sort. If I estimate a VAR or any other model using the whole sample, I have a huge look-ahead bias. I'm assuming that at any point in time, investors could actually see exactly what was coming in. Now, if I don't do that, of course, and I end, for example, the sample at the end of World War I or end of World War II, then I completely miss the fact that the UK was going to have a regime change, and the debt actually was, in retrospect, completely sustainable because things have changed, not just in the surplus, but in the way to discount it. So I think if you are interested in the topic, you can look further in the work of John Campbell and Jan Martin, who are actually building on this paper and revisiting it. They start from the point that the debt to GDP ratio is not stationary, so we cannot do the Campbell-Schiller approximation the same way. They propose a different log linearization, a different measure of fiscal backing. We call it a fiscal position, and they have a really cool result. By definition, it has to be that the fiscal position predicts either the future returns on the debt, the default being the extreme case, or the future change in the net surplus. And what they find when they estimate this on the UK over the whole sample is a bit of both. UK at some point had a really bad fiscal position, but it implied that the price of debt was going to change, but also that the UK was going to change in the way it runs the government. I will finish
1 minute.
You said 2 minutes. By talking about convenience yield, but I won't need too much, because the way it's computed in the paper is by looking at interest rate differences across countries. That's for the gold standard period, or looking at the difference between the interest rate on the CDs or acceptance paper and the treasury bills. And with those paper numbers, exactly as Wendy said, the senior rate from the convenience yields are relatively small, because you see, I could make the same point without even talking about those. So actually, they don't really matter for the big point. The point I want to make now is that I think that on top of it, those convenience yields maybe are a little bit lower than what is estimated in the paper. So here's, just for the fun, what I did. I look at the gold standard, really 1872, 1913. I pick a bunch of countries. It turns out of those countries, some countries gone in and out of the gold standard, so it's not, the exchange rate is not always constant, and so you always have a chance that the country will get out, or that the interest rate is going to move sharply against you. And if I sort now countries on the basis of the level of interest rates, I take the perspective of the UK investor, and I look at how much money they could make by borrowing in the UK and investing there. I sort countries into 5 portfolios on the basis of interest rates. You can see that I recover currency excess returns that increase on average from the first to the last portfolio. Now, what is fun is that actually I can explain partly of this currency excess return as just covariance, co-movements between the returns that the UK investor would get and some kind of risk factor. And here I went back to the risk factor that Hanno and I loved, the average return on the currency market and some measure of carry trade. And so if you want to talk about convenience yield, well, it has to be the alpha. It has to be the part that is not explained by risk. And the alpha on average is pretty much 0. So that period, I think measuring convenience yield just out of interest rate difference, I would be a little bit worried about that. And over the more recent period, what you can do is just look at the CIP deviation. You look at the interest rate in the US compared to the interest rate that you would get if you were to borrow in a different country and hedge the currency risk. So that's a topic that I love. I just want to show you a paper by Victor Degors, a Princeton student who's going to be on the market, and I really recommend this year. And he just look at the CIP deviation over time going back. I think if we wanted to do the exercise that Mindy has in mind, we would need to look at the CIP deviation that are negative. These are the only ones that matter when actually it's really less expensive to borrow in dollars than to borrow in a foreign currency and get rid of the currency risk. But if you don't do that and just look at the absolute basis, you get something like not even 15 basis points on average, and that's half of what is in the paper. Conclusion. It's a great paper. I highly recommend it. I really enjoyed reading it. You just learn a lot on the fiscal history of those 3 episodes. And I think the bottom line is something that I completely believe it, so I'm going to repeat it one more time. When a country is a dominant safe asset supplier, it can issue more debt than what is justified by its future primary surpluses. I think the results are intuitive, they are robust to the choice of the risk premium and to whatever you put on the convenience yield. I think congratulations on your forthcoming publication. Well done.
Well, thank you for the discussants and the paper givers being so close to being on time. Nonetheless, we only have about 12 minutes. So what I'm going to do is ask one question to each of the paper givers, ask them to comment on anything they want to say to the discussant, as well as my question together, so that we can at least have a couple questions from the floor. First question is for Steve, and you avoided political economy questions in your paper by and large. Kristin raised some of those political economy questions. And so my question for you is that you highlighted the balance sheet operations or fiscal policies. However, unlike fiscal actions, central bank balance sheet actions are done by unelected officials. One reason for allowing the central bank to engage in large balance sheet actions is because it normally happens during a crisis. Hence the pandemic, hence the great financial crisis. However, do you think, given the political economy cost of the Fed may be much larger than the economic cost that you documented, do you think there should be time limits or limits on balance sheet expansion relative to GDP, after which formal approval by elected officials should be required?
Thanks. I guess we don't have microphones or something.
Yeah, so yeah.
Okay. Yeah, thanks. Thanks for that question. That's a great question, and I think we could probably spend an awful lot of time debating it. I think I'm not in favor of. I would not be in favor of formal rules, but it's certainly the case that agreements on the expansion and the contraction of the balance sheet would seem to be reasonable. As I suggested at the end, and I think we're going to hear some more of this over dinner from Peter, I think that we need to think very hard about how it is that the central bank fiscal authority arrangements have to be structured today. We're living in a world where those structures are basically worked fine until about 2009, and then after that, they sort of changed. And so the question is, how is it that we should would organize them? I mean, I do believe in central bank independence, but central bank independence has to come with some restrictions, has to come with clear mandates, and has to come with clear statements about what the instruments are that are being used. And I think we're missing those right now. So you ask, I think, really important questions that we really have to, I think, do need to struggle with, and I don't have clear answers today. Thanks.
Thank you, Steve. And for Mindy, you document the exorbitant privilege, and I really like the fact that you have such a long historical period to actually look at. I'd never really thought about the Dutch experience, so it was nice to have that in the paper. Sorry I rushed you so you couldn't really go through it. And your paper kind of highlights what makes a safe asset supplier. It's notable, first of all, that you shouldn't lose a war. That both the Dutch and the British stopped being able to be safe asset suppliers after a highly destructive war. So lessons for the United States, we shouldn't lose wars. But a more serious comment, this literature is very closely tied to being a reserve currency. And in the reserve currency, less focus on what the fiscal authority is doing, more focus on stable and dependable trading partners, rule of law, protecting investments, and stable and credible monetary policy. So I'm wondering, as you think about the safe asset supplier and you don't have any role for monetary policy or rule of law, how you think about your work and how it ties to that adjacent literature with the reserve currency.
Okay, thank you. That's obviously a great question. Can I say I don't have a clear answer yet? But I do think it's very important. I mean, it's definitely beyond the scope of the paper. This reduced form model can capture. We can really just focus on the government, how healthy the government balance sheet is. But I do think all these factors you mentioned will be indirectly or directly factored in this, what we ideally call the multiplier. It will impact, it's not just the physical fundamental, but also beyond the scope of the physical fundamental, also the economic fundamental, right? How the reserve currency is the USD versus used to be maybe pounds before or under the gold standard was all linked to the economic fundamental, and maybe beyond that, regulations, monetary policy, how stable this is, how the policy tie together. So. Quantitatively, I don't have a good answer how much it will change the estimates, but I do think in a full, rich economic model will be all embedded in this multiplier estimates. Ideally, we want to have. Yeah, thank you.
So I think we have time for one or two questions. If you want to ask a question, why don't you just come up to this microphone? Try to keep it short. We only have about 5 minutes.
Serendipitously, at the Greenwich Economic Forum yesterday and the day before, the hot topic was China. So, sir, Professor Cecchetti, is there enough data for you to include China in your analysis as you did with the US and the UK? And for Professor, Xiaolan, Ray Dalio, who was the keynote speaker, he was talking in his book. He's an investor in China, but he's this great video that says the same things you did. He does that at 4th grade level, but it's really good, and you might want to see how you compare notes. You have all the math, he has all the pretty pictures for 4th graders. Yes, you know it. He also starts with China prior to Dutch, and then he continues with China and the US and the expected war in 2060. So a lot of interesting things. He also drives it by the level of education and technology and entrepreneurship in the countries of the Netherlands, US, China coming up. So that might be of interest just for pretty pictures for your slides. But if you have any data on what's happening with China, I'd be appreciative. Thank you.
Anybody? You have to come up to the microphone, unfortunately.
I'll make a very quick comment. There's aggregate data on what China's balance sheet is divided between the PBOC's actual balance sheet and the balance sheet of their exchange rate, of their foreign exchange reserves, basically SAFE's balance sheet, which is huge. But the one time I looked at it some time ago, all I could see were aggregate data. So I don't know that it's going to be possible to do anything close to what we're doing. What we're doing actually requires that you know quite a bit of detail about the holdings, which we do know for a lot of Western central banks, and we would know in principle, in fact, even for something like the Bank of Japan, but not for the Chinese, at least as far as I know.
I wasn't sure that was a question or not, but I know this will come up with next. I've been asked many times. And I do know the Ray Dalio's kind of sort of prediction about the next nation. But this is definitely a multi-trillion-dollar question. So long story short, I think we will need to look at the data more dynamically to give. I cannot give any predictions, but I just on the side, I think he has changed his predictions a little bit recently. He was very bullish on China being the next one, but I thought there's some change in that expectations lately. Yeah, but anyways, thanks for the suggestion, yeah.
I think we have time for one last question before the panel comes on. Any last question? Okay, if not, we'll thank the panel and the discussants. And we'll make room for the panel to come up.